as the panel are assembling, we have saved the best to last. It is my great honour to introduce John Stratanu, who, looking at his CV, I feel a complete waster. Having tried to spend most of my time on the African continent, I've not done very well compared to he, who spent most of his career on the continent, developing a vast amount of experience from being an engineer, educated out of Princeton, to business in Georgetown. But truly, one receives the education on the continent, whether it's Ghana or elsewhere. John is Managing Director of Pangaea. He will be chairing the panel today, and he brings a wealth of experience both from the private sector, the public sector, but also the not-for-profit sector. So without further ado, I'm going to hand over to John and his panel for the last session of today. Thank you very much.
Good afternoon, everyone. We're going to jump right in and try to make this an energetic session. We have 45 minutes, and what we'd like to do is have 30 minutes of discussion up front and have 15 minutes of Q&A from the audience. So please do prepare your questions. What we're going to do is have 2 minutes for each of us to introduce ourselves. I won't introduce the panelists, but they'll introduce themselves, 2 minutes each, and then we'll have 5 questions. And so those questions, we're looking forward to your input on those questions as well. So without further ado, I'll start here on my right with Mark, and each of you will have 2 minutes to make a quick introduction to yourself and your organizations.
Great, fantastic. Thanks, John. My name is Mark Tyndall. I head up a consumer-focused investment fund based out of Johannesburg and Abidjan, spread across those 2 locations. We are funded by a family office, Mary Oppenheimer and Daughters, and Temasek, a Singaporean sovereign wealth fund. Obviously invest in business models in retail, FMCG. We've invested in education, healthcare, and we've made a number of agri investments. We're not principally an agri fund. The agri investments that we've made are in berries in Morocco, exporting into Europe, and an animal protein and poultry business in Kenya. Personally South African, studied in Cape Town, and actually here. And it's a pleasure to be here this afternoon.
Happy to take the next one because South Africans always come in 2. So very proudly wearing 2 hats here, one of them being the South African side. So I run my family office, which is based in Cape Town and focused on diversified investments, and including the fishing industry and aquaculture industry. The second hat is representing ABLIN, which is a pre-competitive collaborative body for the continent of Africa, focused on helping aquaculture farmers from around the continent at various levels of scale. And we focus on really providing the technical know-how, giving them support in developing the industry, and helping to turn the industry in what it really should be in providing food at a continental-wide level at very big scale.
Thank you. Then I guess I take you back to Western Europe. So my name is Iveta Tancheva-Nikolova. I represent Finance in Motion, and we are based in Frankfurt, in Germany. We are an impact asset management company. We manage a number of impact funds. The fund that I am leading is called the Sanad Fund for MSMEs. It's a financial inclusion fund. It has been active in Middle East, Northern Africa for the past 14 years. Since 5 years, we have also expanded to Sub-Saharan Africa. What we do is we finance SMEs, micro and small businesses on the ground with a very strong focus on agriculture. In Sub-Saharan Africa, we see that this is an important sector which generates a lot of the employment on the ground, and that's why it's so important for us. I look forward to exchanging on how we can scale investments in agriculture even further, because it's so important for the people that we want to support. Up to you.
I'm Sergio Sanchez, also another impact asset manager, also specialized in agriculture and mostly investing in Sub-Saharan Africa. I come from Inox Capital. We're a Swiss-based impact investor. We have offices in Geneva, Zurich, some people in Côte d'Ivoire, South Africa, also people in Ukraine. Managed north of 550 million, deployed over 7.5 billion with a B historically. We have 20 years of track record. And as said, we focus on providing financing to SMEs, mid-market companies across the entire food and agri-value chain. We say anything that goes from farm to fork, we can finance. And of course, being the senior impact analyst, I have to talk about our very strong impact framework. We assess and work with all of our investees to provide with positive impact in 4 impact themes: food security, poverty reduction, environmental quality, and women empowerment. That's us.
Great. And I'm Jumani Tafawa. I'm a co-founder of Africa Eats. We are an investment vehicle based in Mauritius. We invest across the food and ag value chain. We have about 22 companies in our portfolio. And we scale companies from literally tiny tens of thousands of dollars in revenue and take them to double-digit millions. And then most recently, we've been listing them on the stock market of Mauritius. And we're starting to now expand that where we list them on other markets across sub-Saharan Africa. So using public capital to invest in private companies, scale them, so that the continent can feed itself, reduce post-harvest loss. And then, yes, through that process, being able to replicate that across the continent. So that's Africa Eats in a nutshell. Thank you.
Excellent, thank you. So we've got a diverse set of experiences on this panel. And we'll jump right into the questions. As I said, we had 5 questions, and then we'll ask for your input into these questions and others if you have them. So the first question concerns SME and smaller ticket sizes. I've heard a lot of entrepreneurs raising concern at this event, saying that many of the capital providers are looking for large tickets, and many of those seeking capital are SMEs. And so, Raihan, if you could address this question, what innovations are driving the flow of capital to SMEs that are really the backbone of African economies?
Sure. I'd love to just unpack that second half of the question, which is that SMEs are the backbone of African economies. And if we just take aquaculture, for instance, like at the moment, aquatic foods, like 20% of global aquatic foods comes from Africa, 2% of which Africa takes the aquaculture production world. And then we always go back to this figure of that Africa is going to have the largest youth population by 2050. So we have declining oceans, which is our 20% output, and only 2% of aquaculture in the world. So who is going to be the people that are going to be producing aquaculture? And it has to be the SMEs. So with that in level of importance, that's what we're looking to address. And so when it comes down to why don't SMEs get funding, firstly, we're not looking at it in terms of the right lens. So we need to start thinking about blended finance, which has obviously been a very topical conversation this year, but it's not quite there yet. Secondly, we need to be looking at impact funding. And then thirdly, we need to be looking at basically how we can get into the right areas through the right people. And by the right people, I mean Africa's large, SMEs are small, and investors have big checks. So in order to get down to the right people, what we need to have is someone that's going to be able to collect and provide a consolidation of those SMEs and essentially act as the one that is sort of de-risking simply by the fact that they understand the industry, they understand the technical know-how, the regulation that goes behind it, and then the financial risk associated with that. So when we have a player, and for example, it could be Ablin in this network, the African Aquaculture Business Leaders Network, who then acts as de-risking the industry, it means that when a DFI does come along, they have the ability to go to that body and say, okay, tell me about the industry, tell me about how we need to go about investing this, and tell me about how I can use my capital in order to access many, many SMEs across the continent, instead of saying, okay, the DFIs need to go to an SME, because that's not their remit, and we need to be able to provide a bridge in order for them to access the market.
Mm. Yeah, that resonates with our work in Ghana too, where industry and business associations have been a very important channel for us to identify promising companies that have been established, many of them paying fees to these organizations, and they're clearly one of the ways to build pipeline. Jumani, I think you wanted to chime in on this too. You've been investing in small, not just medium, but small businesses. So what's your perspective on SME finance and a bit of the gap that we find between the larger ticket size investors and the need of the bulk of enterprises in Africa?
No, it's a good question. I mean, I cannot fault the capital that has come in focused on SME that's no longer focused on that size growth. The amount of work that's required is probably as much work, if not more, than focusing on a larger ticket size. So what that necessitates is looking at completely different structures from the traditional ones that we see. So for example, in the case of Africa Eats, you can do due diligence. There's a cost to doing due diligence, but what we found is because we invest small ticket sizes, our most effective form of due diligence is actually allocating capital. So you give a $5,000 check to a small company and see how well they do. Then you give a $10,000, and you give a 15, and a 30, and you slowly build up. So typically, before we've actually invested in that company, we've actually given you a certain amount of capital, seen how you've performed, your responsiveness, et cetera. And then after that, we can then say, this company comes into our portfolio. The only reason we can do that is because we work with accelerators. And so we invest through the accelerators into these companies to see how well they do. So that's just an example of an alternative model. But I do think that because there's a cost involved, because there's a time, whether it's a time cost, whether it's a financial cost involved, thinking about it using traditional methods is always going to run against constraints. And I think there are different models out there in terms of how we can think about doing the same type of work, but in different forms.
Great. Very interesting. Turning due diligence on its head, really, and basically making the investment a form of due diligence. We'll move on to the second question, which is about the risk and the perceived risk of agriculture. I know the previous panel discussed the same thing. There's so much perception of high risk in the food and agriculture sector, and yet we're overcoming it. So, Sergio, could you share your perspectives on perceived risk versus actual risk?
Yeah, agri is often seen as too risky. Agriculture in Africa is often seen as even more risky. There's a lot of risks surrounding the sector, environmental, climate risks, etc., etc. I don't think risk is bad inherently. We are all in the business of risk. We as investors are in the business of risk. Everyone with a company is in the business of risk. With risk comes returns. We particularly at Inox, going back to the point on the DD, we own the due diligence. We run the due diligence in-house. We have very strong both operational and sustainability due diligence to really understand the business of our clients. And what we do with risk is we structure it. We provide with short-term working capital facilities, 360 days facilities that our clients can use for their working capital. And that working capital is collateralized and self-liquidating. And that's how we can structure that risk. Those facilities are backed by the commodities that we finance, the receivables, the inventories, and that way we can work with that risk. By investing in the SMEs and mid-market companies that we support, with that very strong due diligence process that we go through them and all of the impact and ESG work that we do with them, we also can control the non-financial risks, but also risks that can turn into financial, again, being climate risk, for instance, but also can prove that these companies are investable, can prove to DFIs and commercial banks that these companies can become recipients for more institutional funding.
Does anyone else want to jump in on this question?
I mean, maybe I can say a few words on perceived versus real risk. I agree with you that the risk is part of the business. You can't eliminate it. What you can do is try to mitigate it, to manage it to the extent possible. And what we do in Sanad, in addition to the structuring that you mentioned, is that we do offer a lot of capacity building support to our investees. When we identify a gap during the due diligence, we then come back with the consultancy support to address that gap. Sometimes when it's a matter of environmental and social issues or governance issues, this is part also of the investment requirements, that there is a plan to address those gaps. So we don't wait until everything is being addressed and only afterwards invest. but we go hand in hand, but there is a very clear plan by what time what needs to happen in order for the gaps to be closed. And that's why I think capacity building and technical assistance is a very potent instrument to reduce the real risk, not only the perceived risks, but the real risks in an investment, especially in agriculture, where there's so many components that can go wrong and can ultimately lead to a loss in the investment.
Let's dive into one particular kind of risk that we face. I know in Ghana we have currency risk that's very high, resulting in extremely high interest rates. Mark, what can you say about volatility and currency risk and how you can manage that in our space?
Yeah, John, so I mean, I'll look at this, I think, sort of fundamentally from a fund perspective. The first thing that we would do is look at, what is the FX risk in the operating model? So we'd look at things like, is there FX risk in the inputs? We'd look at localization of inputs. I mean, that would apply to most business models. We're sort of fairly allergic to seeing a high level of FX exposure in the inputs of any business model. It could be grocery retail, it could be an agribusiness. So look at the inputs in the income statement, to what extent there's FX risk in that, and to what extent you can localize. So I think that's very important, and that then can lead to building out sort of value chain in lots of different areas and lots of the agri inputs. I think the second thing, which is not always possible, is as a fund we would focus quite strongly on, is there an export component to the business? That would be much more favorable for us. So we're invested in a berries business in Morocco, as I mentioned, which exports into Europe. We're also invested in an animal protein and poultry business in Kenya. So the poultry is kind of exclusively domestic. The small livestock is export. We also have a little bit of a story there around kind of, it's not just food security for foreign states at the detriment of a local producer. It's around food security both locally and in the export markets. But exports is not always possible. So I think you also got to look at the financing model. It's not always possible to localize the inputs, so you then got to look at things like hedging. And I think the final point that I'd make on financing is sort of concessional capital, first loss capital. I think the food security space is an area where there's availability of first loss capital. To come in and say you have dollar investors or euro investors or Swiss franc investors, and they need to invest in effectively largely domestic industries, and they're running per se an investment FX risk, and some level of first loss capital can come into play to kind of insulate that. I think on the volatility point, it's not just FX, it's also volatility of input costs per se. So in the poultry business, we've backward integrated into feed. Obviously, food conversion ratios and things is absolutely central to competitiveness. So obviously controlling your own feed means that you have a very strong handle on what drives competitiveness. But what we also do is we see a lot of volatility in the margins in our feed business, and we're okay with that. At times, that business is barely break even, and at times it's making good money, because what we do is we insulate the contract farmers from variability in maize and soya, and that way you develop serious loyalty with the contract farmers, on top of which you're hopefully working with the right genetics. You hopefully have some sort of assistance, either financially with the contract farmers, especially if you've got a long-term relationship, and you can have technical assistance with them as well. So I think you got to just kind of unpack each bit of the volatility and say, fundamentally, who's best placed to manage this volatility? And sometimes it's a trade-off between short-term profitability and long-term strategy.
Yeah, I think the piece about the inputs is particularly interesting, and I know there are efforts to catalyze more investments in inputs in the feed, in fertilizer, et cetera, but those efforts often seem nascent because frankly, the import costs are high and it's in FX, and that creates a large currency risk. So interested to hear how the audience might respond to that. Any other comments from the stand on volatility and FX?
I can add a little bit on there. I think just carrying on that point from the inputs, that when you look at it from an industry perspective, especially like for aquaculture, there's so many different elements that come in there, and I think the more and more you uplift the industry and you focus on like a systems level thinking where you have not only, okay, here's the farm, but here's where the grain is coming from, or this is where the feed's coming from, or the hatchery, etc., for the aquaculture side. And when you have a local industry and you start to add different elements of it, where you're not just focusing on one part of the industry, which is the farm itself, then you can actually start de-risking in the same way that Mark's touched on.
All these institutional barriers. There's a book by Tarun Khanna about, I can't remember the name of it, but it's about the institutional barriers, and each institutional barrier is an opportunity that we begin to chip away at them. Yvette, the next question is for you, and it touches on what you've already said about support other than financing. Is financing enough? Are we doing enough? In the previous panel, there was a discussion about the financing gap, and is it theoretical or is it a real pipeline of companies? So could you say something about, is financing enough? What else are you doing? What else do we need to do in order to catalyze more deal flow?
Yeah, I mean, in certain cases, financing is enough. I think when the companies are big, stable, they've been in the market for many years, they have established business models, there is very little that they need to learn in order to become more successful. Then financing and the right type of financing is sufficient to take them to the next level. But very often, especially when we deal with smaller agricultural businesses, what we find out is that the liquidity, the pure credit line is far from enough, because they operate in a value chain, and along that value chain there are a lot of things that need to be addressed in order to make this business successful. Starting from the very small farmers, smallholder farmers, or small SMEs that are working at the bottom of the value chain. They're usually very unsophisticated. They produce in the same way that they have done for 20, 30 years. There is very little deployment of technology or modern agricultural production methods. So this is where we focus, again, with non-financial services, with capacity building, to basically allow them to produce more with less, to improve their efficiency, to improve their productivity, and in this way improve the livelihoods of these really small subsistence farmers. We try to strengthen the value chains as well across the whole length, so from the very small farmers to the processors, to the logistics providers, to the ultimate aggregators, because we do believe that a strong value chain then ultimately is more competitive, is able to add more value, to grow, and to guarantee a better source of living for the small businesses that are at the bottom of it. And last thing I wanted to say is that sometimes we find businesses that have the right ideas, the right, let's say, business propositions, but they are far from being ready to receive financing. They lack the financials, they lack the corporate governance structure, they lack the strategy, and this is where we come with pre-bankability assistance to get them up to shape. I think, John, this is something that you are very familiar with and you do on a day-to-day basis. It takes time. It's over months and months of support and making them ready and in a bankable state. But in the end, it does pay off. So I think financing is not always enough. Patience is needed, and also a lot of hand-holding and non-financial support to make this work at the scale.
Sergio?
Yeah, I want to pick on that last point that you meant about patience, because often we speak about financing and TA as being two things that are separate and two components, but I think there's a third component that's a lot softer that often is overlooked, which is how the investment is managed. How, when you provide financing to a company, to an SME, to a mid-market company, how you work with them. Do you, as an investor, provide with the facility, wait until termination and then collect, or do you actually support the business to grow? That we do at Inox. We have a lot of expertise on the commodity markets and support the companies to find off-taker agreements, find suppliers, this and that, but also on the sustainability perspective, the work that I'm sure you at Finance in Motion do as well, of supporting them to embed the SDGs, the IFC performance standards, that really helps them to grow. So it's not only financing TA, but that software of how you manage the investment that I think is also really important.
So emphasizing the post-investment needs of the company as well as the pre-investment needs. And I'll just make a comment on that because the ecosystem, the entrepreneur support ecosystem in Africa, one might argue has been largely ineffective. If we're not seeing the deal flow that we need today, if the companies aren't investment ready, then maybe we need to turn investment readiness on its head and technical assistance and pre-investment support. So perhaps we can welcome questions from the audience on how we can innovate, not just on the supply of capital, but on the demand side to help companies, especially if we want to be inclusive and climate smart and invest in local companies, how these can rise up to become ready and deals can get done. The last question, Jumani, I'll address this to you. This is about learning across regions. Sometimes we kind of get stuck in our geographies, but you're investing all across Africa. So what can we do more to use models from one country to another, even from one region to another, even outside of Africa, but within sub-Saharan Africa, so that we can do more learning about what's working in one place and bring it to another?
Okay, great. I guess I'll be open and honest and say, as an investment vehicle, we have definitely tried coming up with different models for how we think agriculture can be done. And we've applied them and worked with our companies. And I would say almost none of them have worked. What we've learned is as much as we can top-down kind of direct how things go, that doesn't quite work, or look at models in other markets and say, let's replicate it. What we've learned is just, if you will, being hands-off and allowing the entrepreneurs to be able to create their solutions. And even though we may not necessarily agree with some of the strategies and the way they expand their businesses, give them that free will to expand and to learn and sometimes fail and then to learn again and continue. And so we think that one effective approach, if you will, is just the idea of giving the entrepreneur, or I guess having a long-term view and investing smaller amounts of capital that allow the entrepreneurs to experiment and try different things. Whether it's expanding into a new market and maybe that works, or maybe it's a subsequent product line, et cetera. That's one model that we've seen works. The other model that we've also engaged with and seen is the use of, well, we've heard blended finance, we've heard commodity financing. One thing which we have seen is looking at community-based models. So we've come across a couple instances where we've seen, I guess whether you call them, but basically a group of people coming together and then financing one another at an earlier stage. So this is looking at early stage businesses. That way, the capital doesn't come from an institutional investor, doesn't come from a traditional PE fund, et cetera. But financing a group, we found that from that group, some capital goes in. There are about 5 to 10 different types of businesses that are in that pool. Out of that pool, if we invest in that pool, 1 or 2 of them may become successful. And then from there, you can then say, okay, that's something scalable and that's something you can expand into. So that's a model that we've seen work in a few markets, in Rwanda and in Uganda. I think the third model that we've seen has just been looking at the logistics infrastructure. So there are a couple companies that we have seen that have accidentally got into logistics because there's been a shortage. And what we found is from that logistics, they're able to tell whether there are shortages of certain commodities or certain products in certain markets. And then just from that identification, we've then been able to see other investors come on board and then start investing. Like, for example, we saw there was a large amount of poultry that was being imported in certain markets. And so on the back of that, we've then seen other investors come in and say, okay, this looks like an area to expand on. So one thing I would say is the lack of information that's shared between all the different investors within the agricultural value chain means there's lots of missing information, and everybody's functioning in their little silo. But if we were to collectively share the lessons we're learning, it would allow us to be able to reduce the number of mistakes and allow us to be able to find where there's greater opportunities to be able to expand the companies in those markets.
Jumani, I know you've done several honey investments. Maybe Rehan, for you to contribute to this as well. I mean, you're in the agriculture space.
Pick up on that. Yeah.
Surely there's some learning between agriculture companies in different parts of Africa, and they can copy something that works in one company and bring it in one country and bring it to another.
Absolutely. And I think everyone, the initial response that is always like, oh, but competition. But at the end of the day, you share so much more and build so much more value together when you are communicating with each other. And that two words I can pull out of there is like the transparency and secondly the community. Firstly, like when you share across different companies, different countries, and you're creating a pool of data, and that pool of data supports the entire industry, where people then become more trusted of this industry. You create a track record through that. And then the second side, which is that community aspect that Jumani touched on as well, is that a farmer in South Africa and a farmer in Kenya or Ghana, they're not actually competing. So by having a conversation and sharing about their technical know-how, being able to talk about some of the problems they're facing, maybe it's about diseases, maybe it's about what antibiotics or pesticides in the case of farming to use. That small conversation creates so much value, and that's exactly what we're trying to achieve with Abilene, and I think any industry should really be focused on creating that base level communication, sharing of best practices, and ensuring that we help each other on the continent rather than focusing on siloed operations.
Great. We've talked about 5 questions, and now we've kept to about 30 minutes. We have 15 minutes left, and we'll open it up to you. So we'll take a couple of rounds of questions, and please be brief, but state your name and your organization, because as we know, this is just sort of a pathway to deeper discussions. As the last session of the day, we can leave here and continue the discussion. So share your thought or idea or question quickly, and no more than a minute, and then we'll take 3 of those and give some responses. Who will be the first? I'll call on you if we don't have more questions.
We also have another one over
There's
here.
one more.
Oh, yes, we have here.
Thank you. My name is Tanya Kamatu. I work with the Alliance for Green Revolution in Africa, AGRA in short. So my question is channeled towards Iveta. I think the point you raised about supporting SMEs or small companies to become, through the pre-bankability phase and providing that capacity building support. I'm very interested from an AGRA perspective, how you select those firms that have because I'm sure that the demand is very high. So how do you narrow in on the firms that you're going to provide that TA support to? And then what model do you use? Do you partner with development institutions? Is it in-house? I'd be curious to learn more and potentially talk on the side about the capacity building work you do. Thank you.
Excellent. I know we have one up front, and then we'll take one more.
Hi, thank you so much. My name is Fabian Johannes. I represent Almeta Impex PLC. It is, we have several commercial farms. One is large scale, actually about 300 hectares. This farm does require a strategic partner. And one of the elements that we're looking at is, first of all, this is the audience that we wanted to speak to. But the sustainable agriculture. So is it important, is it something that we need to focus on in terms of organic agriculture being an area that we need to meet a certain guideline in order to be attractive for foreign investment? That's key for us. So, and then I would like to have a personal conversation with one of you. Thank you.
Thank you. One more question for this round.
G'day, I'm Craig from Africa Legal, which is a media and education company for the African legal profession, tries to bring all them together. And my question is in relation to the legal and regulatory environments in different African nations, because they are very different. How much does that impact how you choose to invest and investors' decision making, and what do some of the African governments perhaps need to do in terms of legal and regulatory reform to encourage more investment in agriculture?
Great. So 3 questions from Agra on how do you select companies to provide pre-investment support, a question on Ethiopia and organic agriculture and how much is that prioritized, and third on the legal and regulatory context. Who would like to start?
Maybe
Yvette,
I can
please, yes.
start with the first one. So pre-investment support, I think the typical route would be that we identify a potential investee. It meets some of our eligibility requirements, the most important, of course, being the impact that we are seeking to achieve, which is to reach out to the small and medium-sized enterprises on the ground. And then, of course, there are others, such as some sort of financial statements, track record on the ground, at least some basic E&S systems put in place. And we start from there. We do a due diligence, as I mentioned. We identify the gaps which we think might prevent us from investing in the first place. And then we work to close those gaps. This is the direct support. This is usually for potential investees. When we talk about equity investments, this is a different ballgame because there the companies are much smaller, in much earlier stage of their development. We cannot go one by one into each and every one of them. So there we try to work with partners such as accelerators, incubators that we provide support to, and they in turn formulate the programs, the specific assistance that is needed for their cohorts of equity companies to make them investable, to make them ready for the first equity round. And then we participate with equity investments. I don't know if this fully answers your question, but this is what we are going through. Anybody else?
Organics?
I'm happy to touch on organics. I know it's from aquaculture perspective, but I think that aqua and agri are so similar in terms of the problems that they're facing. And I actually think that to answer your questions, that absolutely, we need to be focused on sustainable practices because we have 2 pushes, and one of them a pull, another push, where investors are pushing down the fact that they want their investments to be ESG compliant. If you're coming from Europe and you're investing into Africa, for example, they sometimes unfairly make you adhere to the standards that are in Europe in terms of ESG reporting and compliance. But there's no reason why in Africa we can't start with sustainability at its core. So there's this huge push from investors where actually going down the sustainable route means you get access to more capital. And yes, you might have a few hoops to jump through, but that's why industry bodies exist to support that. That's why others who are there, consultants, legal experts are there to provide that support. And then from the consumer side as well, I think it's such a big push lately, especially because if I just take the aquaculture example of salmon in South Africa, where it started almost 10 years ago or 12 years ago in South Africa, and then there was a huge fallout, and it was a result of the consumers pushing back against the waste in the industry. And that was one example, and it didn't represent the industry, but that meant that anyone who came into South Africa afterwards had to ensure that they had their company focused on sustainability in terms of the full process, because it was a consumer-demanded criteria. So absolutely.
Can I just quickly, and thank you for coming in, because I was trying to think something more insightful to say other than yes. Because for us, it's almost a belief that we invest in that sector. But aside from what you mentioned, I think it's also business intelligent to do. There's a push from the big corporations, the likes of the Nestle's, etc., for traceability in the commodities that they purchase for the product. So by investing in organic, in sustainable agriculture, you're also opening a market for itself. So yeah, definitely yes.
Just a quick point on this. I think for our companies, when we address this from a compliance perspective of it's required by the DFIs, then it didn't work very well. Mm-hmm. But when we took the time to think about this in terms of how do we make you more either more efficient, how do we help you, how does this help you grow? When we looked at all the pointers they looked at and presented it from that perspective, then it kind of took off. And so I think you take the challenge that it looks like, and then you spin it on its head, and then you say, now how do we make this an opportunity? And some of our companies we found were doing things we didn't even realize were actually more sustainable than what we were kind of forcing down their throat. So different perspective.
Last chance. We have a few minutes, 2 minutes. Anyone? 1, 2?
There was one more question, the regulatory question.
Yes, did you have something for that?
Yeah, I mean, I'll just make a very simple comment on that. I think that for us, it's just more than what the regulatory context is, it's the consistency of the regulatory context, so that there's a predictability, the rules of the game don't get kind of changed on you. I mean, I think about the Moroccan example. That business is a majority Moroccan-owned business. Technically, that business is allowed to own land in Morocco. That said, we lease most of the land on 99-year leases. It's not easy to get land in Morocco to develop. It's quite a process, but it is what it is, and it's consistent. And so you work on it for an extended period of time, and eventually kind of things come together and they drop, and there are not a lot of kind of negative surprises if you go through the right process and you are sustained about it. So you're likely to be successful. So for us, it's much more around the consistency. I think where it can become kind of quite problematic is where there are import controls, and those import controls are on and then they're off and then they're on and they're off, and that's understandable because they lobby groups in all directions. But that's understandable. But if you're going to invest, you need to understand that over a reasonable time period, you can get a return on a sort of, there are no commitments for forever, but over a reasonable time frame, there's stability.
Okay, very quickly, the last 2 questions.
Good evening, everyone. My name is Ajibola Edwards. I'm a partner in the law firm of AK & Co. based out of Lagos, Nigeria. Hi, John. Nice to see you again. My question is, do you think that the lack of large food manufacturing companies in Africa is affecting your investments in agricultural companies? Thank you.
Was there one more?
Sorry, I was just going to double down on that question about regulatory and geographical risk. My name is Zoe. I'm from Chiconia Investment Partners. We do quite a lot of different investments across the continent and helping a couple of our portfolio companies scale. And we found that, not all risks are created equal for the same kind of business, same size, same performance. In Kenya, that will get a lot more different kind of reception from investors than a company based in, DRC or Niger or some of the more challenging places. So kind of doubling down on that question, there are these big countries in Africa with a huge population to feed, but unfortunately have very complicated regulatory contexts. How would you encourage, ecosystem players to go into it, either from an investment perspective, either from a policy-making perspective? What can some of the, private sector companies do also to help strengthen that kind of capital flow and capacity building process? That's my question.
Great. Time is limited, but quick answers to both of those questions.
I'll go first quickly on the first one. And thanks for that question. It's going to make me think about it in the next coming days. My first quick answer would be no from our perspective, because we focus on SMEs and mid-market companies. So from an investor perspective, perhaps no. But then as I was thinking that, I'm actually thinking yes on the side of the impact and the sustainability, because by having larger companies producing in Africa, the value addition stays in Africa, which is one of our objectives. So thanks for this. Actually, really good question. Thank you.
Last chance.
Maybe I will take the second one because I agree with what you're saying on the first one. Indeed, if we can make sure that more of the value that is produced in Africa stays in Africa, we would wholeheartedly do so, right? But the question on regulatory risk and country risk that we face in the different countries in Africa, I think some of it is unavoidable. and has to be managed. We are all investing in emerging markets, so we cannot expect things to be the same as elsewhere. The other thing I wanted to say is that there are certain ways in which you can structure the funds so that you request additional capital to bear country risk, to bear FX risk, which Mark mentioned earlier. And this risk capital is your blending. This is what really protects you against the worst that could happen. From then on, it's a matter of selecting the best possible investments that you could in each and every country. But what I'm saying is that, I mean, in emerging markets, this is part of doing business. We cannot somehow make it disappear.
Maybe I can make a few comments on that. I mean, the other things that you can do, you can get like MEGA insurance, which protects against, things like expropriation. You can partner with the right people, and there it can be, some of the DFIs. I think that, some of the DFIs particularly play a key role in that because they give some sort of level of air cover, effectively, and they have, influence. But that's not necessarily, something that you can rely on. So I think it comes down to kind of looking to see what you can insure against, and it'll come down to kind of, what's the evaluation of the risk and the reward, and you'll probably look at that and say, look, we need disproportionate upside here, and you might want to go into it a little kind of on the slow side and see how it goes and try and get some cash out. I mean, the DRC is a dollarized economy, and get some cash out, and so effectively you don't have it all on the table at the same time, as it were. But I think the reality is it's tough, and it's a major barrier to investment. I mean, that's just the hard reality. We don't like to go and invest in places where we feel, property ownership is not clear, where we're subject to kind of various forms of, shakedown. It's just we just don't go there, and sadly, that can keep you away from certain places or lend itself to people investing, which we certainly can't do, but investing alongside people that we wouldn't want to invest alongside in the first place because they've got the domestic contacts.
Yeah.
But it's an issue. I think it's a major issue across the continent.
Okay. Maybe sorry, quick minute.
Yes.
One alternative approach to think about this is getting more local capital invested can actually make a difference.
Yeah.
Like, for example, we found that when you get like the pension funds involved and et cetera, I mean, you have to structure something to get their interest, then there's a lot more weight that they have in terms of shaping policy, whether it's regulatory or whether it's finance, or also in terms of from a de-risking perspective. So I think that's also another approach. How do you position and offer something in a way that would be interested to get more local capital that then allows you to have that leeway?
Great. Thank you, panelists. I'll close with just a couple of remarks on this last point. I think we all recognize that this is actually life and death work in some ways. I mean, we're talking about food security, we're talking about nutrition, and places like DR Congo or Burkina Faso or Mauritania. You look at the state of food security. I don't know if you haven't looked at it. Have a peek at the state of food security FAO report. Food security is not getting better in Africa; it's getting worse. And we no longer have the aid structures in place with all their challenges and inefficiencies. Many of them are USAID, for example, and other budgets are coming down. So we need the private sector to be producing more food, producing more nutritious food, producing strengthened, resilient livelihoods. This will be the only way to prevent what could be catastrophic reductions in food security and nutritional outcomes. And so how do we creatively reach those markets? It's not just Kenya, Nigeria, South Africa, Egypt. We all need to think about how we can innovate there. And AGRA, thank you for that question. AGRA has done such great work in some of these markets and is doing so much to invest in farms, invest in policy, invest in research. But the question is, how can that be translated to the private sector? And I think in many ways, AGRA could do better to work with the private sector, work more closely with investors and facilitators like Pangea to say, how do we find the best companies that are going to move the needle, that are going to produce more nutritious food, that are going to support farmer livelihoods, so that we actually are results-oriented. And so that's just a few closing remarks. I'm sure all of us will be ready to discuss these points as we're near the end of the day. Come chat. Thank you for your participation, and Keep up the good work. Thank you.
Thank you.